It's back to school week at Morningstar. We're covering all the investment basics, and to help, we've called in a team of young experts.
Hello, my name is Amy Thompson-Cobb and this is Helaine Kang, and today we're going to be talking about ETFs. What is an ETF?
ETF stands for Exchange Traded Fund. So ETFs are index funds that track certain indices or the basket of securities selected via certain criteria. And index funds are some sort of mutual funds. And then the underlying assets can be anything from equities, bonds, or other asset classes like properties or commodities. The main advantage of ETFs is definitely makes investors' lives easier because you don't need to select individual bonds or stocks individually, but you buy the whole basket. So you don't need to study the whole individual assets and then pick your own portfolio.
When is it good to use an ETF?
So active portfolio managers, they actively pick stocks and investment time. They pick the time of the market, the best time of the market to buy and sell the stocks. And then their aim is to beat the market by buying the cheap undervalued stocks and sell the expensive overvalued stocks. But then when the market is efficient meaning the market reflects the fair price of the stocks or underlying assets quickly and effectively, then there are not much room for active managers to outsmart or outperform the market. Then in that case, investors can better off by owning the whole market as a whole or a broader segment of the market, instead of relying on the small stock bets or a small selection of the asset class.
And when is it not?
So not all indices are designed to represent the market as a whole. So there are many indices that has small number of stocks or a small number of assets. And sometimes these indices try to follow the trend of the market or a segment or sector of the market. So in that sense, in that case, active managers who have the expertise in those kind of small region or country or the sector or industry, they might perform better instead of the whole industry itself. So that could be the case. And for example, emerging markets, for example, Russia or India, that kind of countries, local knowledge matters more than owning the whole market itself. So that could be the case to have the active fund.
ETFs are usually quite cheap. Why is that important?
Well, the active fund, as I mentioned, they do the active research, and then that comes at a cost of hiring the whole team of analysts to do their own research and generate the investment ideas. On the other hand, ETFs, because they simply follow the indices, they are predefined rule-based investments, they come at a significantly lower cost. And these, fund management maintenance costs, at the end of the day, it's either fund itself or investors who needs to pay. So these differences in cost matters in terms of the fund performance. So there are many studies that confirms average fund managers, they actually underperform the market when the costs are integrated into their performance.
Thank you, Helaine. Goodbye.